Right now, as you are watching this video, something is happening in the financial world that most people will completely ignore. Not because they are not smart, not because they do not have money, but because they do not know what to look for. And by the time they figure it out, the window will already be closing. My name is Zara, and I have spent years studying the behavior of money, markets, and the one metal that has quietly outperformed entire economies during the most uncertain times in modern history. Today, we are talking about silver, and we are talking about it right now because the Federal Reserve has just made a move, and what comes after that move is something every long-term investor needs to understand before this moment passes. But before I tell you what is coming, I want to tell you about a mistake I once made. A mistake that cost me not just money, but time. And time, as any real investor will tell you, is the one asset you can never get back. Several years ago, I was watching silver the same way most people watch it today, from a distance, with curiosity but without conviction. I had read about it, I had seen the charts, I had heard the arguments, but I kept telling myself, I will wait for the right moment. I will wait until things are clearer. I will wait until the news confirms it. And then I waited too long. Silver moved, quietly at first, and then very quickly. And I watched from the sidelines, telling myself, next time I will be ready. Next time I will not hesitate. That lesson stayed with me, because it was not really about silver. It was about understanding why certain assets move, when they move, and what signals to look for so that you are never again caught watching from the outside while the opportunity walks past you. So today, this script is about giving you that understanding. Not a trade, not a tip, not a promise of easy money, but a framework, a way of thinking that will serve you not just today, but for every major financial cycle you will live through in the decades ahead. Let us start at the very beginning. Let us talk about what silver actually is, why it matters, and why the Federal Reserve's decisions have always been, and will always be, one of the most powerful forces that move this metal. Silver is not just a commodity. It is not just something that sits in a vault or gets turned into jewelry. Silver sits at a unique intersection in the global economy. It is part precious metal, meaning it carries store of value characteristics similar to gold. And it is part industrial metal, meaning the real world needs it to function. Electronics, solar panels, medical devices, electric vehicles. The demand for silver is not driven only by fear or speculation. It is driven by the actual physical requirements of a modern, growing world. This dual nature is what makes silver unlike almost any other asset class. When economies are growing, industrial demand for silver rises. When economies are uncertain or contracting, investment demand for silver rises. In both scenarios, silver has a reason to be relevant. And that is a very powerful position for any asset to be in. Now, here is where the Federal Reserve enters the picture. The Federal Reserve, for those who are newer to this world of investing, is the central bank of the United States. Its decisions about interest rates, money supply, and monetary policy ripple across every financial market on the planet. When the Fed raises interest rates, the cost of borrowing goes up. The dollar tends to strengthen, and assets like silver and gold often face short-term pressure. When the Fed pauses, or pivots, or signals that rates will come down, the opposite forces begin to take over. We are now at one of those pivotal moments. The Fed has been in an aggressive rate hiking cycle. Inflation was the enemy, and higher rates were the weapon. But every cycle turns. And when the Fed signals a shift, when it pauses or begins to reverse, historically, silver has responded in a way that rewards those who are paying attention. The last time we saw a similar Federal Reserve pivot environment, silver moved significantly within a compressed time frame. Not because someone predicted it, not because a guru called the top or the bottom, but because the underlying conditions that drive silver's value had aligned, and the market simply reflected those conditions. So what are those conditions right now? That is exactly what we are going to unpack, step by step, across all 5 parts of this video. In Part 2, we will go deeper into the relationship between interest rates and silver and why the post-Fed environment is historically one of the most significant setups for this metal. In Part 3, we will talk about the mistakes most investors make when they approach silver, including the ones that seem smart on the surface but quietly destroy long-term returns. In Part 4, we will build the actual long-term mindset framework, the way of thinking that separates investors who truly build wealth through commodities from those who simply speculate and lose. And in Part 5, I will give you the most important warning of this entire video, one that could protect you from a mistake that even experienced investors make when they feel the urgency of a moment like this one. But for now, I want you to sit with one single idea from this first part. The Federal Reserve does not move in one direction forever. No central bank does. And when that direction changes, every asset class in the world recalibrates. The question is never whether silver will respond to these changes. It always has. The question is whether you will understand it deeply enough to act with patience and wisdom rather than panic and impulse. Most people will hear the words silver and Federal Reserve in the same sentence and either dismiss it entirely or rush toward it with no real understanding. Neither of those responses will serve you. What will serve you is what we are building together in this video: understanding, context, and a long-term perspective that the noise of daily financial media will never give you. You are here. You are listening. That already puts you ahead of where most people are right now. Take a breath. Stay with me. Most people hear the words Federal Reserve decision, and they think it only affects stock markets or mortgage rates or the price of the dollar. They do not connect it to a metal. They do not see the thread that runs between a central bank's boardroom and a bar of silver sitting in a vault somewhere. But that thread is very real, and once you see it, you cannot unsee it. Here is the core relationship you need to understand. When interest rates are high, holding silver feels expensive. Not because silver itself costs more, but because of what economists call opportunity cost. If you can put your money in a government bond or a savings instrument and earn a meaningful return, why would you hold an asset that pays no interest, no dividend, no yield? This is the logic that pushes investors away from silver during rate hiking cycles, and it is a reasonable logic on the surface. But here is what that logic misses. It misses the moment when rates stop rising. It misses the moment when the Fed signals that the tightening cycle is over. Because in that moment, the opportunity cost argument begins to collapse. Suddenly, holding silver does not feel like a sacrifice. Suddenly, the reasons to own it, the protection against currency debasement, the industrial demand story, the store of value characteristic, all of those reasons come back to the surface. And markets move before the news confirms it. Markets move on anticipation, on expectation, on the reading of signals that most people have not yet processed. This is why the post-Fed pivot environment is historically so significant for silver. It is not that the pivot itself causes silver to rise overnight. It is that the pivot removes the primary argument against holding silver and simultaneously reawakens all the arguments for it. Think of it like a dam. During a rate hiking cycle, the dam holds back the water. Investor interest, industrial demand growth projections, inflation hedge positioning, all of it is held back by the pressure of high interest rates. But when that pressure begins to ease, the water does not trickle through. It moves with force. And the people standing downstream, the ones who understood what was building behind that dam, those are the people who positioned themselves wisely. Now I want to address something that many newer investors ask at this point. They ask, if this relationship between rates and silver is so well known, why does not everyone simply buy silver every time the Fed pivots? It is a fair question, and the answer reveals something very important about how markets actually work. The relationship is well known in theory, but in practice, human emotion gets in the way. When the Fed is hiking rates and silver is under pressure, it feels wrong to buy it. The news is negative, the charts look discouraging, the financial commentators are focused elsewhere. Buying silver in that environment requires a kind of patience and conviction that most people simply do not have, because most people invest based on how they feel right now rather than what the conditions suggest about the future. And by the time the environment shifts, by the time silver starts moving and the news becomes positive and the commentators start talking about it, most people are buying late. They are buying because of excitement rather than understanding. And buying late, with excitement rather than conviction, is one of the most reliable ways to end up disappointed in any investment. This is not a small distinction. This is the difference between an investor and a speculator. The investor studies the cycle. The speculator follows the crowd. Right now, we are at a moment where the Fed has signaled, through its language, its tone, and its actions, that the aggressive tightening phase is either over or very close to over. The conditions that suppressed silver are beginning to ease, and the conditions that historically support silver's value are beginning to align. I am not telling you what to do with your money. That is not what this video is about. What I am telling you is that understanding this moment, this specific configuration of Federal Reserve policy, dollar behavior, real interest rates, and industrial demand is the foundation of any intelligent decision you might make. Without this understanding, you are either ignoring silver entirely, which may cost you an opportunity, or you are rushing toward it out of fear of missing out, which will almost certainly cost you something else. The goal of this part was to give you that understanding. The goal of part 3 is to make sure that understanding does not get destroyed by the most common mistakes investors make when they approach silver. Because knowledge without discipline is just expensive education. I have seen it happen more times than I can count. Someone does their research, they understand the macro environment, they connect the dots between Fed policy and silver's historical behavior. They make a thoughtful decision to invest. And then, somewhere between that decision and the actual outcome, something goes wrong. Not because the thesis was incorrect, but because of how they executed it. There are specific, recurring mistakes that investors make with silver, and I want to walk through the most important ones, not to discourage you, but to arm you. The first mistake is treating silver like a short-term trade. Silver is a cyclical asset. Its major moves happen over months and years, not days and weeks. When investors enter silver with a short-term mindset, they set themselves up for a very painful experience. They buy, they watch the price move against them for a few weeks, they feel anxious, and they sell. And then silver does exactly what the long-term thesis said it would, just without them in it. The moment you buy silver, you need to ask yourself honestly, can I hold this for 1 year, 2 years, or longer if the cycle takes time to play out? If the answer is no, then you are not ready to invest in silver. You are ready to speculate in it. And speculation in volatile commodities is a very different game, one with very different odds. The second mistake is putting too much into a single position too quickly. This is what urgency does to investors. When a title says last chance, when a video creates a sense that the window is closing, the natural human response is to act fast and act large. I want to be direct with you here because this is important. The urgency you feel right now is real in the sense that cycles do have windows. But no single window justifies concentrating your wealth into one position. Not in silver, not in gold, not in any asset. The intelligent approach is to build a position gradually, to enter in stages rather than all at once. This approach, which experienced investors call dollar cost averaging, removes the pressure of timing the market perfectly and allows you to accumulate an asset across a range of prices rather than betting everything on a single entry point. The third mistake is confusing the different ways to own silver. There is physical silver, meaning coins and bars you can hold in your hand. There are silver ETFs, which are funds that track silver's price. There are silver mining stocks, which are companies that dig silver out of the ground. And there are silver futures and options, which are derivatives that most retail investors have no business touching. Each of these is a completely different instrument with completely different risk profiles. A person who buys physical silver is making a different bet than a person who buys a mining stock. The mining stock adds a layer of company-specific risk, management quality, production costs, geopolitical exposure of the mine, on top of the silver price itself. Physical silver is simpler, but comes with storage and liquidity considerations. Many investors mix these up without realizing it. They think they are buying silver exposure when they are actually buying a leveraged, complex position that behaves very differently from the metal itself. Know exactly what you are buying. Know its risks. Know how it behaves. This is not optional. This is the foundation of responsible investing. The fourth mistake, and perhaps the most psychologically destructive one, is checking the price every single day. Silver is volatile. It moves up and down sharply, often without any fundamental reason. If you are checking your silver position every morning and making emotional decisions based on daily price movements, you will drive yourself into poor decisions. You will sell on a temporary dip. You will panic on a bad week. You will abandon a good long-term thesis because of short-term noise. The investors who do well in silver are not the ones who watch it the most. They are the ones who understand it the most and then have the discipline to let time do its work. None of these mistakes are signs of stupidity. They are signs of humanity. We are all wired to respond to urgency, to fear loss, to want results quickly. The market is designed to exploit exactly those instincts. The only protection is awareness and a written plan that you commit to before the emotions arrive. Part 4 is where we build that plan, not in numbers and portfolios, but in mindset. Because the right numbers in the hands of the wrong mindset will always produce the wrong result. Everything we have covered so far, the Fed relationship, the historical cycles, the common mistakes, all of it is information. And information alone does not make anyone wealthy. What makes people wealthy over the long term is the framework through which they process that information and the discipline through which they act on it. So let us talk about mindset, not in a vague motivational way, in a specific, practical, financial way. The first principle of long-term wealth building through commodities like silver is this. You are not trying to be right about the next month. You are trying to be positioned correctly for the next cycle. There is a profound difference between those two things. Trying to be right about the next month means you are competing with professional traders, algorithms, and institutions that have resources and information you will never have access to. That is not a game you can win consistently. But positioning yourself correctly for a multi-year cycle, understanding the macro environment, understanding where we are in the monetary policy cycle, understanding the supply and demand fundamentals of an asset, that is a game where patience and knowledge genuinely win. The second principle is this: every real asset allocation decision should begin with a question, not a prediction. Most investors begin with a prediction. They say silver will go up, and then they build a case for why they are right. This is backwards. The right approach is to begin with a question. What conditions historically drive silver's value? Are those conditions present today? What would have to be true for this thesis to be wrong? And what is my plan if it is wrong? This question-first framework forces intellectual honesty. It forces you to consider the scenarios where you are incorrect, which means you will never be so overexposed to a single idea that being wrong destroys you. Wealth is not built by being right all the time. Wealth is built by surviving the times you are wrong and being well positioned for the times you are right. The third principle is about the relationship between patience and compounding. Silver, held over long periods with clear understanding and managed position sizing, is not just about price appreciation. It is about what it does to the overall structure of your wealth. A meaningful allocation to hard assets in a portfolio that also includes income-generating assets and growth assets creates a kind of stability that purely stock-focused portfolios often lack during monetary disruptions. When currencies are under stress, when inflation erodes the purchasing power of paper money, real assets like silver do not just hold value. They rebalance the portfolio. They protect what the rest of the portfolio might be losing. This is not exciting to talk about. It is not the kind of thing that gets clicks on financial media. But it is the thing that keeps wealth intact across decades and across crises. The investors who came out of the 2008 financial crisis with their wealth preserved, and in some cases significantly grown, were not the ones who predicted the crash. They were the ones who had built portfolios that were structurally resilient to the kinds of monetary disruptions that eventually did happen. The fourth principle is one that almost nobody talks about, and it is the most important one. Your investment horizon should be longer than your emotional horizon. What I mean by this is simple. If you plan to hold silver for 5 years, but your emotional tolerance only allows you to handle 3 months of discomfort before you sell, your real investment horizon is 3 months, not 5 years. And that gap between your planned horizon and your emotional horizon is where most investment returns go to die. Before you invest in anything, sit with the worst realistic case. Ask yourself what it would feel like if this position dropped 30% and stayed there for 18 months. Because in commodities, that is not an unrealistic scenario. It happens. It has happened to silver before. And the investors who held through those periods and came out the other side were the ones who had prepared themselves emotionally and positioned themselves financially so that holding was possible. You prepare emotionally by having clear conviction based on real understanding, not hype. You prepare financially by never investing money you cannot afford to have locked away or temporarily depressed for an extended period. This is what separates long-term wealth builders from people who perpetually feel like they missed the opportunity. The opportunity is always present for those with the right framework. The question is whether you will build that framework before you need it or after. You are building it right now. Part 5 is the most important part of this entire video. It carries a warning that I want you to hear clearly, because it is the one thing that could protect everything we have discussed from being undone in a single impulsive moment. We have come a long way together in this video. You now understand why silver responds to Federal Reserve cycles. You understand the mistakes that derail even well-researched investors. You have the framework for long-term thinking that most financial content will never give you. And now, I need to give you the most important thing of all: a warning. Because moments like this one, moments of genuine opportunity, are also the most dangerous moments for investors. Not because the opportunity is not real, but because urgency and opportunity arriving together create the perfect conditions for poor decisions. Here is the warning. The phrase "last chance" is one of the most powerful and most dangerous phrases in finance. It creates a psychological state where normal caution feels like weakness, where slowing down feels like losing, and where the fear of missing out overrides the discipline that good investing requires. I used that phrase in the title of this video intentionally, not to manipulate you, but to reflect exactly the kind of language you will encounter in the financial world around moments like this one. And I want you to be immunized against it. There is almost never a true last chance in investing. What there are windows. Windows of better conditions, windows of stronger setups, windows where the probability of a thesis playing out is higher than usual. Those windows are worth paying attention to. They are worth acting on, thoughtfully and with appropriate sizing. But they are not the last train leaving the station. They are not moments that justify abandoning your process, concentrating your savings into a single bet, or making decisions at midnight because a video made you feel like morning will be too late. If silver's post-Fed setup is as significant as the macro environment suggests, it will not be over in 48 hours. Real cycles play out over months and years. The investors who benefit from them are not the ones who acted in a panic tonight. They are the ones who acted with clarity and conviction, in appropriate sizing, with a clear plan for both the upside and the downside. So here is your clear takeaway from everything in this video. Study before you move. Understand what you are buying, in what form, with what portion of your capital, and with what time horizon. Write that down before you act. Then, if the thesis still makes sense after you have done that work, move with confidence. Not because a video told you it was last chance, but because you understand the conditions, you have managed your risk, and you have built the kind of conviction that will hold through the inevitable turbulence ahead. Silver has rewarded patient, informed investors across every major monetary cycle in modern history. It has also punished impulsive, uninformed ones. The difference between those two groups was never intelligence. It was always process. You now have the beginning of a process. Protect it, refine it. Do not let urgency destroy it the moment it feels inconvenient. This is Zara, and the most powerful thing you can do after watching this video is not to rush to buy something. It is to think deeply about everything you have heard, do your own additional research, consult a qualified financial advisor if you have meaningful capital at stake, and then make a decision that you can stand behind a year from now, regardless of what the price does next week. Real wealth is not built in moments of urgency. It is built in moments of clarity. Protect your clarity, always.